İstanbul hattında piyasalara özel bir parantez açıyoruz. Bu bölümde Barclays Ekonomik Araştırma Direktörü Keller'la birlikteyiz. Hi Christian, welcome to our show.
Good morning, Berfu.
It's such a pleasure to have you back on the screen after a long time. Thank you so much for making this time to join us. To begin with, if I said the 10-month balance sheet of the markets, what would be your headline?
I think the headline must be much better than expected. If you go back to where we were at the beginning of the year, but in particular, in April after the, so-called Liberation Day, I remember, we were coming to the IMF spring meetings in end of April, and everything was quite gloomy. There was an idea that, the tariffs that the US was now imposing and the uncertainty they could create would really weigh heavy on the global economy. There's also the idea that there would be a large outflow, persistent outflow out of dollar assets, as there was a debasement of the dollar. And now I just came back from Washington actually last week for the annual meetings, and it's completely changed. The US economy in particular has remained very resilient, but even the other economies, including Europe, China, have been doing better than expected, quite resilient with regard to the trade changes. And the dollar, after initial brief sharp depreciation, has been quite stable. There's not much mention about a persistent flow out of dollars. So I think that is really the main headline, much better than expected. And if you want really an everything rally, right? If you look at markets.
Mm-hmm. So, Christian, why do you think this is the case? Because there are lots of risks out there: government shutdown, geopolitical risks, credit risks. Do you think the markets are ignoring these risks right now?
I mean, first of all, it is true that the economy has been much more resilient. So companies have been much better and much more agile in a way in dealing with these trade disturbances, right? I think there's a general belief among economists in particular that this will still come in the future. We will see more price pressures, etc. But the market is looking at this now, and they see maybe that there are more risks going forward from trade, from geopolitics. At the same time, though, we have a very positive AI story developing. The first half of this year, probably half to 2/3 of US growth was driven by an AI capex story, investment in AI. And I think that is this is a structural change completely independent of geopolitics, which markets are quite optimistic about. Could that be a bubble? Maybe, but most people don't think immediately. So, I'm thinking the market looks at all these risks and, is probably rational ignorant. However, I think you very correctly pointed out, we see that whenever a new headline emerges, like regional banks risk, last week, markets get quickly very nervous. So I think markets are long, but uncomfortably long. They're seeing the risks. They want to stay long, want to stay exposed. But when something happens, they do get nervous because they don't know where the risks will come from, but they know that valuations are very stretched.
So in this US, Europe, China triangle, how do you see the position of European countries and Europe performing, as this is so much important as our largest trading partner for Turkey?
It's a very good point, because there is a feeling among global investors that Europe is getting squeezed, so to say, between the US and China. And, Europe, where will it stand? Will it side with the US, be tough with China, but it's very dependent on trade? Now, so far, even the European economy, even though it's growing very, very slowly, but it has been more resilient than expected. And now there's a lot of hope, and that will be relevant for Turkey as well. There's a lot of hope that the German stimulus program, the big fiscal stimulus Germany is planning to invest in infrastructure, which will probably start kicking in next year, that could provide some boost for Europe. But the situation for Europe continues to remain difficult with that struggle between the US and China.
So what about euro and euro dollar parity, both year end and 2026?
I mean, the euro and the dollar have been a very interesting story, right? We were almost at parity at the beginning of the year. And then, as I said, the currency moved at some point 118, 120. People thought in April, May, it could go to 130 or higher. I think that illusion has proved to be an illusion. I think that's gone. We now see clearly that there is no more momentum in a way to move out of dollars. Europe itself, if growth comes back, if the ECB stays steady at 2%, which markets believe, and if the Fed continues to cut, we expect actually the euro to remain where it is, but it has enough support not to go to parity. So, levels where we are probably the ones where we may actually remain for some time.
And when you look at the big picture, how do you think the countries like Turkey as emerging markets are performing?
Emerging markets in general have been doing quite well in this scenario. It's interesting because typically when you hear global trade war, Turkey, a country that is trading a lot, that's a bad sign. But I think investors have realized that, with the unpredictability of some of the US policies, and I just said, of course, people remain long the dollar, but there has been a flow to emerging markets. People say, look, I have to spread myself. I have to diversify my risks. And Turkey is, of course, an interesting country from that perspective, given, the high yields it has. There's, also a component where Turkey does feel pressure now from China, and that is Chinese goods can no longer go into the US markets, but the exports from China remain high. What's happening? They're moving across the world. They're moving into other emerging markets, moving into Europe, and they're moving into Turkey. So I think Turkey now feels that pressure of probably cheap Chinese goods entering the market, which is, good for some consumers, cheaper goods, but of course it puts pressure also on some of the industries.
Last question, as we head into the remaining months of this year and into 2026, what are the key indicators and developments you'll be watching most closely?
I think we're all watching now, what will happen in the US-China trade talk. I think the market expects that they find a solution. We had this escalation of words before, but I think that is important to watch because if there's no compromise between the two, that could be an impact on markets if tariffs are ratcheted up. I think markets continue to follow, of course, in the US, the regional bank, the credit risk. We've seen this moving up. Some of the private credit, there's a bit of a battle between private credit and US banks. Whose fault it was not to see some of these defaults? Was it fraud, etc.? I think markets are following that as well. And then I would say coming back to a fundamental topic, and that is, how much can the Fed stay cut? And that will depend on inflation, but also on a very important decision, no longer this year, but in January, how the Fed will decide, the Supreme Court will decide on Lisa Cook case. I think, that has gone away right now with the first decision. But if the court in January was to decide for the president against Lisa Cook, in a way, creating the impression that the president in the future will have a lot of more power over the Fed, I think that could be another impact on markets, in particular on the dollar, because foreign investors will become wary about Fed independence.
Christian Keller, thanks for joining our program.
Always a pleasure.
Barclays Ekonomik Araştırma Direktörü Christian Keller'la buluştuk. Sözü tekrar İstanbul'a bırakalım.